good morning, everyone. And thanks for joining in a big crowd. I think 2 years ago I said I would like to have a huge crowd in the soccer stadium. But this is a nice turnout. And especially in light of what one journalist said this week, a lull of corporate activity. We will show you that this is not the case. We just are proud to actually announce to you, beside very good results, we are announcing 2 deals which we closed in the last 2 days. So, lull of corporate activity, we had to fight back on that statement. Welcome to everyone. Welcome to the webcast people in London, and hopefully somebody made it also in New York. It's the middle of the night still. Or in Singapore, our supporters from the Far East. Thanks very much for all joining, and Kieran and I are happy to present to you a great set of results. Let's go into the numbers, and as usually, I will give you an overview. Kieran will talk about our financial results in detail. Then I go to operational performance and take you through our strategy, our 4 pillars of strategy, and how have we been performing against these 4 pillars of strategy. Quick overview. You know our business, a health and care brands company. But something has changed, and you see this on the right. We are now 41% a business based in Europe and 59% in Africa, and of course the majority of the 59% is South Africa. We have diverse revenue streams also from a product point of view, and I will talk later about this. But what is most appealing actually is our graph on the left. Revenue growth, a CAGR of 78% over the last 4 years, actually 5 years, since H1 2013. And an EBITDA CAGR of 120%. Now I ask you, where do you find this in the South African environment? This is a very compelling story, and it's based on a team effort. You see here, and we are again close to the soccer stadium, you see here the 3 trainers who sometimes have to twitch certain players into better performance. And to use the picture of a soccer team has 11 players. But what counts in the end is the result. And we will show you a great result. We're not denying that 1 or 2 soccer players are maybe not the best ones. And for these, you have the trainers to actually improve them, give them some nutrition, some sports nutrition to bulk up, get more sporty, and actually deliver better numbers. But overall, our team of 11 units, 8 in South Africa, and the 3 international ones, Pharmalida in Spain, Remedica in Cyprus, and Cytec in Hungary. So 11 teams actually have delivered a great result, a great set of results I want to take you through. Organically, not happy with that number. 7.3%, we are aiming for higher EBITDA growth, you know that, and I will address this, why is this, but also what we have done to change this to have a better H2 in this financial year. A strong focus on new product development and introduction of new products in markets. I will talk later about this. We have achieved some synergies all over regions, geographies, and also product groups. We established some new markets. Investment and growth, you all know, there was a lot of corporate activity in July and August, where we raised 1.2 billion in a rights issue and 1.5 billion in a vendor placement. And these 2 big acquisitions came on board in August. So there is some seasonality in our results. But also in this investment for growth, we issued 26 million shares. And for the money we got for that, around 500 million, we hadn't deployed that yet. So if you look at normalized HEPS numbers, of course this has to take in consideration. But Kieran will mention something on that later. And the 2 international acquisitions, Remedica and Cytec, game-changing for us, bringing us into a diversified global business from originally a South African business with some exports. Yeah, and these 2 acquisitions, somebody said to me just now, please talk about what you have done to integrate them. We will talk about this, but overall, very successfully integrated. And I remember there were some people saying, oh, they're going to Hungary and to Cyprus. How will this be integrated? Can proudly tell you they were excellently integrated. But more in that, to that when we go into the later on slides. So like I mentioned, both businesses have transformed us, and you see this in our revenue split. Pharma Med is now 53% from a revenue point of view, Consumer Brands 31%, and the high margins in the pharma business where we have focused a lot on to improve that, improve the pie, the part of the pie of Pharma Med has now a 64% EBITDA contribution. 43% of our revenues outside of South Africa. You've seen the split I showed earlier on. And this is a split where the businesses are based. Of course, Remedica sells a lot of their products not in Europe. They sell it into emerging, fast-growing markets, and this will be seen in their numbers, what I can show you later. You might also recall in September, Kieran and I have been talking about an increase of EBITDA margin expected to be 2%. We achieved 2.1%. So our EBITDA margin over the business sits now on a normalized basis at 17.4%. So also there, we kept our promises, what we told the market, what we would do. But keeping promises is probably best seen in this graph. This graph shows the normalized headline earnings since 2014, so H1 2014. Remember, we listed in November 2013, which was during the year of H1, financial year H1 2014. A CAGR of 71%, plus an EBITDA increase on an annualized number, annual numbers, this green line is annual numbers, going up to 17.4%. This is an excellent performance, but of course you would say, what is that in relationship to how many shares you have issued? And also that is an impressive growth. When you take the shares issued into account, our normalized HEPS grew 30.9% over the same reporting period. And you also remember that due to our rights issue in July, August last year and the debt raise, both of them were considerably oversubscribed. We decided at that time to raise issue another 26 million shares, which brought us around 500 million rand on funds, and we can deploy these funds into acquisitions. I have to be careful what I say, can or actually past, we did, because this is two acquisitions I will talk later about. But if you take this in consideration, and you look actually our historical PEG, our profit earnings growth ratio of 0.46, quite a compelling story, I think. But talking about compelling story, I would like to hand over to Kieran to take you through the financial numbers, what our team has achieved in the last reporting period.
Great, thanks, Carsten. Before I begin my presentation, I'd first just like to thank my finance team for helping me prepare these numbers, and the new finance members of the team from around the world in Hungary, in Cyprus, and in Madrid. I must say that my Spanish can be described as ropey, but it's a lot better than my Hungarian and Greek, which is non-existent, something I need to work on. I'd also like to thank Carsten and Cliff and the rest of the Ascendis team for delivering a solid set of results in what can be described as a tough economic environment. I heard on the radio this morning an economist calling the growth rate pedestrian. A prolonged drought. We had the effect of the drought in our last presentation, and that as you are all aware, in Cape Town has affected some of our numbers. And at the same time, integrating two major businesses into our business. As Carsten said, from a finance point of view, that integration has gone very, very well, and we welcome our new Greek and Hungarian siblings into the family. Going into the numbers, revenue up 66% to 3.1 billion. Just to remind you, Remedica and Cytec are the main drivers of that growth rate. They are accretive from 1st of August 2016. So what this has done is has increased our hard currency revenues by 270% to 1.3 billion. They now account for about 43% of our total revenue. Because of the effects of Cytec and Remedica, we've tried to normalize the numbers as much as possible. So we removed all those costs associated with the transaction, so the DD fees, the debt raising fees, all those sort of costs, and try to give you a normalized picture so you're able to compare the underlying business with the previous years. So on a normalized EBITDA basis, we're up 89% to 541 million. And as Carsten mentioned, that's a 210 basis point increase. Normalized profit after tax increased to 92%. And I'm proud to say that the businesses that we bought, as you can see, are highly cash generative. And that increased our normalized cash flow from operating activities to 406 million. That was up 57% on the prior year. Normalized HEPS up 34% to 74.9 cents. As Carsten mentioned, the additional shares that were taken up and issued in August have diluted that headline earnings performance somewhat. But we're happy to say that that 500 million rand extra that we raised has now been deployed post the balance sheet date. And that gets us into our interim dividend. We declared an interim dividend of 11 cents per share. That's a 16% growth over last year. And I think that speaks to us and our desire to want to pay a dividend that grows year on year, but at the same time supports our growth aspirations. We're highly acquisitive. We use the cash to be able to fund some of these deals. If I can take into an income statement, we've also tried to normalize the income statement here so you can get a better picture of what the underlying business is doing. I'm just going to highlight a couple of lines. I won't go through every single one of these lines. It's quite a busy slide. If I can point you to the gross profit margin, we have seen a dip from 43.5% to 42.6%, and that's primarily as a result of incorporating a full 6 months of Farmer Leader. Farmer Leader, our Spanish business, has a gross profit margin of 35%, but a very high EBITDA margin. So although our gross profit margin has dipped, as you can see, the EBITDA margin has gone up to 17.4% as a result of including Farmer Leader, as well as the cost savings and synergy projects that we've put into place in the last 6 months. The other thing worth noting is our tax rate. As you can see, although our revenue and our profits are a lot higher than last year, our tax has come down. We've got an effective tax rate of 17.5%, and this is compared to 24.5% same period last year. What's driving that lower tax rate? Again, the incorporation of Remedic and Cytec. They come from very low tax jurisdictions. Cyprus being 12.5% and Hungary 20%. Sorry, 19% is Hungary. And then Farmer Leader, who pay no tax. They're an innovative company. They've got R&D programs, so they pay an effective tax of 0. So that's helped decrease our overall tax rate. Just to remind you, there's a non-controlling interest bit that we take out. We own 49% of Farmer Leader, but we have effective control because we have a double casting vote on the board. So we consolidate their numbers 100% and then take out the minority interest in this income statement. So then if we add some PPE, loss and profit, and then add back some intangible amortization, that gets us to a normalized headline earnings of 310 million rand, which is a 105% increase over the 6 months, 151 million last year. Looking at our HEPS and our normalized HEPS, our headline earnings were 171 million. Obviously, those were affected by the transaction costs that I mentioned. About 92 million rands worth of costs, some of them pure transaction costs. A big portion of that was also financing and hedging costs that we incurred as part of that, as part of landing those deals. And then we add back 47 million rand in line with what our peers do. These two adjustments are adjustments that we consistently make every year. We add back non-operational type costs associated with transactions, and then amortization costs, which we consider not to be of an operating nature, and there's no obvious cash flow implications either. That gets us to normalized headline earnings of 310 million rand. Just to let you know what happened with our shares in issue, we started off with a balance of just under 300 million, 298 million shares. We had our rights issue, which, as Carsten mentioned, was oversubscribed in August 2016, so that added another 56 million shares, and with the vendor placement as part of the deals, a further 78 million shares. And in October, we did a further BEE transaction, which added another 3.7 million shares, getting us a total of 435 million shares. And on a weighted average basis, that's 414 million, which is 53% growth over last year. Just to talk a little bit more about that earnings, the impact on the earnings, on the fundraising. So that additional 26 million that we raised versus the pro formas that were in the circular have obviously gone a long way towards diluting that share. So the expectation, I think, that was created in the pro formas was about 83 cents. Additional 26 million shares and the fact that Farmer Leader and Remedica were only in for 5 months and not 6 months has accounted for that difference between the 83 cents and the 75 cents that we've landed up with at the end of the period. But as Carsten has said, it's given us 500 million rands worth of cash. As a finance guy, I like to have a little bit of cash in the bank. But again, we don't like lazy cash. We like to deploy the cash because whatever interest we earn on the cash is not as much as what we can earn from deploying those into further acquisitions. We've also had a smaller translation effect as the rands improved against the euro and dollar, roughly about 11% over the period. We've seen some of our South African export business, some of the results when we translate it back, decrease on a revenue and EBITDA basis, but that's only about 8.5 million rand in the 6 months. Looking at the balance sheet, what I've tried to do here is, again, take out the effects of the acquisition of Remedica and Cytec, so we can compare our South African underlying business with what we had same time last year. Now, as you know, traditionally, we're a company that likes to invest in brands and intellectual property. We don't traditionally like to buy companies with a lot of brick and mortar. That changed somewhat with the purchase of Remedica and Cytec. We added about 666 million rands worth of property, plant, and equipment. But as you can see, along with those two companies came a lot of intellectual property, great trademarks, great brands, and that added 4.7 billion to our balance sheet. I'll talk about the working capital in a bit more detail in 2 slides' time. If I can go over to the next part of the balance sheet, the equity and liabilities. As part of that capital raise, 2.4 billion increase in equity associated with the Remedica and Cytec deals. And then our borrowings increasing. We've got about 180 million euro loan to fund those deals in Europe. We like to match our debt with where we're earning those where our earnings are coming from, so we've matched the European debt with the European earnings. And at the same time, we refinanced our South African debt. We had a domestic medium-term note program, which we have now replaced with other funds, which has resulted in a cheaper cost of funding for us as a group as a whole. The 2 other big lines I like to point out are the deferred vendor liabilities line. There's 90 million euro deferred payment for the Remedica deal that's due in 2.5 years' time, and then a 20 million deferred vendor liability payment for Cytec, which is the 288 million on this slide, which is due in August this year. Just looking at our gearing, as you can see, our gearing has increased as a result of these deals. The graph at the top, what we've done is we've displayed the net debt, so we've taken the euro debt, net of the euro cash, and the South African debt, net of the South African cash, and compared it to our equity of 5.2. And looking at our debt EBITDA ratio, we've seen an increase from the last reported period of 2.5 times to 3.2 times. When we started, it was about 3.5 times. Our covenant is currently 4 times. But we're actively trying to get that leverage down, because as we get our leverage ratio down, our cost of funding also decreases. So everybody's very focused on getting that leverage ratio down. Cash is very important to us. As I said, we look and we buy businesses that are highly cash generative, and we can see the effect of this in this cash flow statement versus last year. So I've looked at a normalized operating profit number of 442 million, added back depreciation and amortization, which is roughly about 100 million rand. And then the increase in working capital has given us a cash flow from operating activities of 406 million rand. Interest has increased versus last year, obviously with our increased gearing. And tax paid, 86 million rand. You might think that looks a little bit strange in light of our tax actually being lower versus last year. The European businesses don't pay provisional tax. They pay an annual tax number in December. So we had the Farm Leader, Remedica, and Cytec payment come through in December, which has driven that 86 million rand number. So cash generated by operations, 200 million rand. How have we used that cash, or where that cash has come from? So with the net proceeds of our share issues, about 2.9 billion rand, the increase in borrowings of 2.1 billion, that enabled us to pay for these two companies in the period. That's 4.7 billion rand outflow. And then we paid our final dividend of 52 billion, and we've repurchased some of our shares in terms of our treasury share repurchase program. So a net increase in cash of 447 million rand. We know that working capital is a focus for our investors. It's a focus for the business as well. And I wanted just to also tease out the effect of the acquisition of Remedica and Cytec. So Remedica is the dark orange block, the increase in working cap as a result of incorporating Remedica into our numbers, and Cytec, the yellow block. So if I can concentrate on what's happened from an organic point of view, from an inventory point of view, as a result of the prolonged drought, we've seen our inventories increase about 19 million more than they should have. Just to remind you, that number was about 40 million at June. We did not produce and procure more inventory in that period. Much of that inventory sold out. So we're pretty happy with the inventory at the moment. The other thing that happened in inventories is that we had a big South African National Blood Service tender where a lot of inventory came in. We've now successfully rolled that capital equipment out into the different areas around South Africa, which has helped get our inventory levels down. Looking at accounts receivable, again, this was tainted with the prepayment of the Cytec numbers at June. So the prepayment of Cytec of 10 million euros was then allocated to the purchase price, which helped decrease our accounts receivable. We've also had an increased focus from the finance shared services team to collect more debt. That's accounted for 51 million decrease in accounts receivable. And I'm quite happy to say that the days from an organic point of view have come down quite nicely. Accounts payable, again, we had 140 million rand accrual at the end of June for the transactions costs for Remedica and Cytec. That was reversed as the cash flowed out in the last 6 months. And with the decrease in inventories, we've also seen a decrease in accounts payable over the period. Now looking at some of our key ratios, what we've done here is we've compared them to June 2016. So that normalized sales number of 2145 is exactly half the number that we showed at our last presentation, as well as the normalized EBITDA number. Looking at interest cover, slight decrease from 4.4 to 4.3. Still a very robust interest cover number. Net working capital days, 138, up from 131. Just to give you a little bit more flavor around what's driving, and it's primarily driven by the inventory days. The Remedica business model is such that they supply a lot of goods to NGOs in Europe, which are then deploy the generic pharmaceuticals in Africa and the Middle East. These NGOs demand two things. They demand a good price, and their reputation is sacred, so they need goods to be delivered in a very short space of time. Now they get the quality from Remedica, and they get the ability to turn around orders because they keep excess capacity in their factory, and they keep excess stock to be able to fulfill these orders. Some of the bigger European pharmaceutical companies cannot turn around these orders in time. So that's their niche, and that's their business model. And that has resulted in our net working capital going up, but we're very comfortable with that because they still are able to generate a lot of cash out of that business. If I can focus on the return on equity ratio, it's gone up 16.7% from 14.3. Again, that's with the 500 million rand undeployed funds as such. So we would expect that ROE to be a little bit higher, and we'll see that ratio improve in the next 6 months. Our ROTNA, which is our return on tangible net assets, has dropped from 35.1 to 26.4, and that's to be expected as we've bought Remedica and Cytec. These are companies with a lot more plants and equipment, a lot more working capital, but we're happy that the return that we're getting on a blended basis is good. And typically we target companies with ROTNAs of about 40%, companies that don't have big plants. This is our first time that we've invested in companies with big plants, and a ROTNA return of 27% we're very happy with. But we expect that to increase as well in the next 6 months. And that's everything from my side. Thank you very much for your time.
Yeah, definitely a solid performance. And talking about a performance, we just launched actually 2 weeks ago a performance endurance range for endurance sports like kayaking, cycling, running. And there you see a picture of Robin de Hood, our brand ambassador in the mountain biking field, who will compete at the Cape Epic in the next 2 weeks with an international field here in the Western Cape. Yeah, let's look at the divisional performance. Turnover and EBITDA, a very solid performance in all over. Of course, some areas, and while we talk about the reasons for that, we would have liked it the other way around. In consumer brands to grow 46% your turnover and 100% your profit, but there are projects we're working on to increase the profit also much more again in the consumer brands division. And there are certain outside effects, not in our control, but also effects in our control on what we're working on. PharmaMed, amazing performance. You grow your sales 60%, you grow your profit 103%. I think we must have done something right for these numbers. And also the Phytovet division. No big acquisitions in the Phytovet acquisition. We had one in January last year, on February last year, called AfriKelp, but that didn't play a big role. And still, 38% sales growth and a profit growth of 53% in an environment despite the drought. So that is also quite a successful picture. And like I've shown right at the beginning, our profit mix is now 64% PharmaMed. And of course, PharmaMed has good, solid margins. This is where we want to be, more or less. But there's a diversification also, like I mentioned earlier, from a geographic point of view. 41% of sales coming from Europe, 59% from Africa, and profit-wise, it's more or less half-half. This is, of course, the numbers, how they are now after 6 months. We had guided early on that we expect sales to be half-half at a full year if you annualize the effects of Remedica and Cytec. So our Africa business grew around 18% with a profit growth around 13%, and Europe grew over 300% profit and over 322% sales and over 300% the profit side. But as you know, the diversification is a huge advantage of our business. Diversification from a geographic point of view, from a product point of view, and from a customer mix point of view. Our biggest single customer, you see here as announced at retailer A, 3.9%. That is important because it de-risks our business. It makes our business resilient, high margin business, but resilience is in the business due to the diversification, also from a customer point of view. But let's go into the 3 divisions. First, the biggest division, the PharmaMed division, which grew 59% its sales and over 102% its profits. So what is it based on? Now, first, Remedica, 5 months in, a very strong performance, successfully integrated in Ascendis, and I have later on 3 slides addressing exactly Remedica to give you a little bit more insight there. Good NPD pipeline, good lined up businesses going forward, so very happy of integrating this more enormously important acquisition for us. In South Africa, we had some once-off costs integrating Acacia into our pharma division, but we're working on rationalization projects actually to improve margins there in H2. We had also effects from some large pharma tenders in South Africa, plus Forex, which put some pressure on South African pharma margins. But there are a lot of dossiers in registration in South Africa and vice versa, some of our South African dossiers in other markets in registration process. Pharma Leader, the Spanish pharma business, focused on high margin sales, and as Kieron said, their GP might not look attractive, but their bottom line is very attractive, especially on the PET level, because we don't pay taxes. So they had strong growth and they achieved numbers above expectations. Also above expectations, the medical device division. Double-digit growth, resulting in further market share expansion. We are a solid number 2 in the South African market with our medical device businesses, and we started a synergy project to integrate the underlying brands in the medical device division into one platform, and I'll show this later with some numbers. Started a medical device training center of excellence. So a lot of things are happening there. Overall, an excellent performance of the PharmaNet division. Also historically, when you look at EBITDA margin growth from 16 to 17, 17.8 to close to 23% EBITDA margin now in this division. And again, that's not the end, because just Remedica is only 5 months in, and it will be at year end actually increase also the EBITDA margin just from a seasonal effect point of view. Consumer brands, one of the players in our soccer team where we have to do some coaching and muscle up them with some whey protein products and some energy boosters. Not for wellness. You remember Wellness Solal, I told you we had employed a new management. Wellness showed again double-digit growth, and especially with our Solal brand. The Solal is one of the most profitable brands in the wellness division, high-end, and they achieved double-digit growth. Multivitamins in mainstream, single-digit growth, but also growth. So the product mix actually shifts the focus on products, on brands with good margins. We expect a strong performance of this division, of this business unit in the second half of the year. Cytec had to focus on mitigating the effects of whey protein price increases worldwide. Whey protein is an input factor in sports nutrition. And they also had to expand in new geographies worldwide, which costs some money, new channels, and to do some brand architecture diversification, so go into new brands, into new channels. So that cost them some money, but successfully integrated in Ascendis. I will give some details on Cytec later. Direct selling was impacted in Nigeria with unfortunately, the situation that it's still difficult to get dollars out of Nigeria. In the market, the sales are doing well, but we deliberately slowed down sales to Nigeria because we are worried that we're overextending our agent there and not getting out the dollars of the market. Skin had a sluggish European demand, but overall satisfactory development. And of course, we have investments in product innovations where we pushed hard. And then, of course, in the wellness section, which is doing quite well and will keep on doing well in the next 6 months. But like I said earlier, 100% sales growth, fantastic, but the EBITDA growth should be bigger. And I mentioned where the players are, where we have to do some extra training sessions. But in the end, overall, also satisfactory development, especially happy that the wellness division, which is the high margin business, is growing again in our channels in South Africa. In a sluggish consumer environment, to achieve double-digit growth with your top brand, this is important, I think. Phytovet division, again, another year of success. When you look actually at the EBITDA margin coming from 12, going to 13.8, now sitting at 15.2. Of course, partially due to the Afrikelp inclusion, high margin business exporting these products. But biosciences, the phyto product, Effecto range, which has a 70-80% market share in retail, and you find in the back of our booklet some market share stats with the sources, be it Nielsen, IMS, and so on, to prove that. But with biosciences doing very well despite the drought. And Kieron mentioned in Cape Town, we all know the drought is severe. In Gauteng, the drought stopped probably mid to end of November, slightly too late for the fertilizer season. The fertilizer season starts in October, but we still could sell out some of our stock, like Kieron mentioned, on the fertilizers. Pet and vet, we're working on the SKU rationalization of this business, and then exciting, as you have seen in the Sense announcement on Monday, we finally could find the vet target. Why were we looking for a vet target? Now, veterinary pharmaceuticals, high margins, very much needed. That was missing in our pet and vet business. We were more focused on pet with some medicinal products. Now the new acquisition of Cipla Animal Health, which I will talk later about, is complementing this. So overall, an excellent performance in our Phytobet division. But let's look at the strategic pillars of our business. And you all know this chart. I've been showing this since 2013, year after year, and it's still our strategy. You know, the numbers have slightly changed over time. I've talked about that, so I don't have to go back into these ones. So with the next slides, I will focus on these 4 sectors: organic growth, then acquisitive growth, synergistic growth, and internationalization. And I'll show you how have we been doing against these 4 pillars of our strategy. Now, as I mentioned earlier, 4.6% organic sales growth overall in our business is not satisfactory, and we're working on that. It has something to do with the drought, with Nigeria, consumer sentiment, but also on the other hand, we had strong growth in the PharmaMed division and strong growth in the Phytobet division. Now, of course, organic growth on the top line doesn't help if you don't create the profits out of that. So profits were better, growth of 7.3% in the turquoise bar, organic growth adjusted for the Nigeria and for the drought effect. But again, that should be better, and we're working on that, and I'm pretty confident that at H2 we will have higher growth rates here again. Why do you base your organic growth on? Of course, it's new product developments. New product developments and launches are the guarantee for success for the future. So there you see some pictures of the relaunched products in Solal, which has a very good shelf presence now with the new concept, very nicely presented. That gave us the double-digit growth again in the Solal segment. Wellness with Jungle Whites, pediatric kids range on mainstream, also get some repackaging. We launched Nimue, a new range of products. Some of the investors came actually to our launch in Johannesburg with Helena Christensen, a supermodel who has been working many years for Victoria's Secret. She is Danish, has a Peruvian father, and she is our brand ambassador. And I remember in one of the presentations, immediately one investor said, "Oh, what does that cost?" Now, of course, we found a quite creative model. She is paid actually on the success of the business. So the incremental additional market cap of that Nimue business. So she is not paid on actually what has happened in the past. Whatever she achieves with our team together, with that AI range, which is standing for aging intelligently, and it's a high-priced range, even above Nimue, which will add nice margins for the Nimue business. We could get on board Merz. Merz is a pharma company in Germany. They focus on Botox and fillers, a huge thing nowadays worldwide, and they actually are very complementary to our Nimue business because we go to the salons, and in the salons they do also Botox and fillers and other aesthetic products. And that will help us with revenue streams for Nimue, selling these products with our Nimue team. We launched a new range of Evox products called Alpha, and very proud of the new endurance range I showed you for the bikers, the swimmers, the runners, and the kayak people, all endurance sports. Cytec launched many new products, new flavors, RTDs, ready-to-drink products on the left. A green range on the top. Europe is very much onto green products. They want to have environmentally compliant products, which are very important when they use them. So a very nice range of additional products at Cytec. That's why I mentioned there were some investments into product diversification at Cytec. And then the pharma business. On the top, you see some of our pharma business products launched in South Africa, and several products of Remedica from Cyprus, which is going all over the world to close to 100 countries worldwide. You remember I showed you this little product. I had to repeat it because we can finally say now we have been successful. What do I mean with successful? When you launch generics, you fight the originator. So this was a first route to market generic in South Africa after the originator came off patent. It's a product for epilepsy, anti-seizure medication, and in December we first time took over actually the originator with our product. So a great success story of this first route to market product, which of course has high margins, because if you have a generic right at the beginning, margins are fantastic, and this product has excellent margins for us. Yes, organic growth. Let's go now to synergistic growth. I always used to show some of our projects we're working on, so this is only an example of the projects. In total, we have more than 25 projects we're working on in synergies with a dedicated team focusing in projects on these areas. So we're quite excited of this second bullet point here, the integration of operations and medical devices. We expect savings in the next years of 30 million rand. In this year, we expect in the financial year 3.5 million, joint procurement of raw materials with Cytec Sports Nutrition around 6 million rand, and we expect over the financial year. And then we have many other projects with NPD, freight, with cross-selling, manufacturing, and even with regional expansion of our brands. Next area of our strategy, pillar of our strategy, is the acquisitive growth. Now, the acquisitive growth, I don't have to talk about this. The numbers speak for themselves. 75% growth. You know, we say our target is 20, so we far overachieved this target due to the acquisition mainly of actually Cytec and Remedica, but also we had in April Acacia, which 1 year before in H1 2016 wasn't in our numbers as Africa, also as Africa. So 75% growth, and you see in this chart the growth in the different divisions. Last pillar of our growth, internationalization. And it wasn't when the Ninigate happened that we started to look at internationalization. 2013, we already talked about we want to internationalize our business. So you see a tremendous growth trajectory over the years in our internationalization. 43% actually of our sales are now international, with some brands having 80% or in the Nimio case 60% of our business already outside of South Africa. Why is that important? We might forget this, but the rand has been a little bit stronger in the last weeks, but the rand is a developing market currency, and over the long run the rand will always deteriorate and go down against the major currencies. So you need international exports into hard currency jurisdictions to balance your import costs, to actually have a natural hedge against imported inflation. And that's also success, this diversification, not only product-wise or customer-wise, but also from a geographic point of view and a mix of our revenue streams. Yeah, let me take you through the two big acquisitions, Remedica and Cytec. And Remedica, as you know, more than 50 years in the market, dedicated to the development, production, and sale of generic pharmaceuticals, supplies more than 300 products into 100 countries, a fantastic manufacturing site. Why I'm talking about this, I shouldn't talk about this. Let me ask actually Mr. Bambis Patrikis, who is actually here to join us, to introduce himself to you with a few words, the founder, the ex-owner, and now the running CEO of this business. Bambis, please maybe just introduce yourself with a few words. Thank you very much, Bambis. And yeah, it's great to have you here. And we know each other now for probably more than a year, and it feels like he has been with the family for many years already. And it's good to have you and your team on board. And thanks for coming to South Africa. It's first time to South Africa. We're very happy to welcome him here. I'm pretty sure he will come more often. Purchase price, just to remind you, we paid 260 million in cash, 90 million euros deferred over 3 years interest-free. Quite an important point. It shows how confident Mr. Bambis Patikis is actually of our business to accept 90 million euros deferred. On top, he has an earnout of 75 million, and he's working very hard to get this earnout. We like this. It has some hurdles. So we only pay this if the business achieves certain hurdles, and the hurdles are quite dramatic. He has to achieve more than 20% EBITDA growth in average over the 3 years. But he is working hard on that and very motivated with his team to achieve this. So he stays on board. Like I mentioned, accretive from August. They had a slow start. And remember, we all shook our heads. We looked at the first month in August, and we had not a good number. But then we realized, actually going to the details, August is the summer month. The production closes, 2 weeks of not having any recoveries from the plant. They do maintenance in the plant, refurbishing, and Cyprus in August is a little bit in a holiday mood like we are in December here in Cape Town. So despite that, 9 million PAT achieved over more or less 4 months. Fantastic number. Double-digit growth. You know, I had guided the market with the 2015 numbers. If you look at the 2015 numbers, December 2015, 9 million profit, you will see far ahead of expectations. So an excellent result. On top of that, we have a project to reduce the tax rate from currently 12.5% to 9% with some ideas. We're talking with the accountants and with the advisors. We have integration projects, and there are still ongoing synergy projects. Some pictures on the plant, a world-class facility. You see on the top left, on the bottom left, you see actually pictures from the oncology suite. Not a lot of pharmaceutical plants have oncology suites, because you produce toxic products. Oncology patients get more or less toxic products. So there you have to protect, of course, the product from the human intervention, but also the other way around. You have to protect the humans from the product because they're toxic. And that's the reason you find these people in kind of these spacesuits actually working there. So not a lot of pharma companies have that, and it gives high margins. Remedica's success is not only that oncology suite, and like Bambis said, the business with the NGOs, it's also the diversification from a product point of view, anti-infectives, cardiovascular, CNS, and even some HIV products, but also the regional diversification or emerging markets, and also the diversification within the emerging markets. A few slides to Cytec. Cytec is number 3 sports nutrition company in Europe, selling to more than 90 countries worldwide, a diversified range, vertically integrated, manufacturing 280 products according to GMP and even FDA, US Food, Drug and Administration Authority accreditation. And they give us a lot of opportunities with synergies between our South African sports nutrition businesses. Also here, to recap, 170 million euros we paid, 20 million euros deferred, lower deferment because of private equity player selling us the business. They achieved a PAT over these 5 months of 3 million euros, below expectations. Major reasons: whey protein input costs increased worldwide, and also we had a diversification, our strategy. We had investments and costs incurred to diversify our regions, our product range, and the channels we go in. We have first synergy projects started, and quite excited going forward. The corporate tax rate will come down in Hungary, will come down from 19% to 9%. I wish we would have this in South Africa, but it's a nice thing going forward to generate high cash flow, from Hungary in order to repay our European debt faster to get better interest rates. The business is widely diversified into protein bars, amino acids, muscle gainers, so a huge range of sports nutrition products. And another point why they are successful, even with the slightly below expectations profit, their profitability is still very good. Why is that? Because they produce in Hungary low cost production in a new plant, 2008 built, SAP run, so the production process is very smooth, and their focus is around 75% of their business goes in these 15 markets, which is mainly Europe, Australia, and the Middle East. Yeah, talking about earlier on, I was talking about the lull of corporate activity. We decided to fight that statement, and on this morning, signed actually last night, so we can be very speedy if we have to. We signed Sunway Pharma, a business in a high-growth business in Romania, an OTC nutrition brand, which is #1 in OTC nutrition in Romania, a high-growth market in Eastern Europe, focusing on food supplements and OTC products. A fascinating business model, and some of you might say, oh, what is this now? It was on SENS announcement this morning. We published 2 SENSes. One was the SENS announcement on the numbers, and 10 minutes later we published the SENS announcement, so you can read this also on SENS regarding Sunwave. A fascinating business model these guys have. They sell with 290 sales reps nutraceuticals to doctors as if it's a pharmaceutical. So you can only sell like a pharmaceutical if you focus on education, on trials, on studies, on clinical data, and they do that. And that's their huge success. A success in 9 therapeutic classes, which gives us an excellent platform in Eastern Europe to go out with our wellness range with them together. Purchase price 42.5 million euros with a maximum deferred payment depending on EBITDA of 23 million. Very important, no equity raise needed for this. We pay this out of Kieron's slush fund. What he said, he wants to keep it in a bank, but in the end he wants to deploy it also into acquisitions. So no equity raise needed for this. Accretive probably from May 2017 onwards. Deferred payments over 3 years. So again, our model worked very well here. 1/3 cash, 1/3 deferred, and 1/3 with debt. The CEO stays on, so there will be another person like Bambis who sold us the business. He was a partial owner and stays on. And we have the right, and we already negotiate interviewing an additional executive to their board. From a numbers point of view, they achieved 3.9 million euro PAT in December 2016. These are not audited numbers yet, but quite high likely that these numbers stay, with an EBITDA margin of close to 20%. CAGR, you're always interested in the historic performance on a sales and profit base, double digit and high double digits, so very nice business. The second business we had to surprise you with was on Monday, and strategically I always a little bit complained that we hadn't found the right acquisition in the vet space. Now finally we found it. A very respected business, founded in 2004, the animal health business of Cipla. Cipla decided to focus only on the human health business, so we buy their veterinary health business. Focused in 2 business on commercial animals with Cipla Agrimed and Cipla Vet actually on companion animals. More than 300 products, 345 products. They have good market positions in South Africa and a little bit in Southern Africa. Huge opportunities from a synergy point of view. If you think about the position we have with Effecto and Maltons in the pet and vet space in retail, and these guys have it with the vet shops and the doctors, high margin businesses, excellent opportunity. What we're paying for this? 375 million rand, of which 50 million is actually deferred over 15 months, interest free, and it's based on the 7.5 EBITDA multiple. This number can go a little bit up if they achieve higher EBITDA numbers, but we have really kept this and made sure that we're not paying too much for this. It will be a 7.5 EBITDA multiple. Expected to be accretive from May onwards. And the PET, they showed 31 million, which was their financial year was March 2016. So you can make your assumptions on where they trade currently. If that would be on a pro forma basis added to our current 6 months numbers, annualized, just multiplied with 2, it would add 33% to the profits of the Phytovet division. So for the Phytovet division, and a very, very attractive and important acquisition, not only because of the numbers, but also strong cash generation of the business, and it exports currently only 10% of its products into Southern Africa, and we can improve this nicely. So an excellent acquisition, but we are all working on further acquisitions because our growth rates have to sustain a 20% top line growth from acquisitions. So expect more to come in H2 of this year. I'm pretty confident that we can announce something else probably at the end of the year. But what is important again for you model sometimes our company, these 2 acquisitions, no equity raise needed. We had raised this with the 500 million and the 26 million issued shares in July, August this year. Yeah, let me come to an end. Outlook, where are we as a company? Now a company goes through a life cycle, and we are now in the time 2017-2018, where we search for further international platform companies and strategic acquisitions to make our business a proper global, how did you call it, Bambis? What was your word? You want to make it an empire. Let's make it an Ascendis empire. I like that. Outlook, a little bit more in detail. We will focus on synergies in the next 6 months, insourcing R&D, cross-selling, customer poolings, geographies, and like I said, a dedicated team working on that with around 25 projects they're following up to work and improve synergies and get bottom line better margins with the existing businesses. We look at production efficiencies. We have some productions now. We have in Madrid a pharma plant. We have in Cyprus a pharma plant. We have in South Africa in nutraceuticals and another pharma plant. There must be synergies between that. They take a little bit longer because of trial batches. You have to do stability data. You have to change your right side of manufacturing with the authorities. That takes some time, but exciting stuff there. Product development, organic growth is based on product development. And I've shown you some of our product development launches, exciting stuff, plus the use of brand ambassadors like in Nimue, in sports nutrition and other areas to push our brands which we launch in the market. Key export initiatives, we are right now launching Ascendis sports nutrition products plus Cytec sports nutrition products in Australia. In the next 6 months, we want to come really to satisfactory levels. And the Australians, I visited some trade, the trade in February, beginning of February in Australia. Very excited about the Cytec range. The Cytec range is really top class from a taste point of view, from a quality point of view. And even if a sophisticated market, Australia likes the products, it talks to the quality of the products. But also Solal probably to be launched. We are aiming at the moment for July 2017 to launch Solal. Also a high positive reception of key opinion leaders in Australia about this. Further internationalization of Ascendis with acquisitions. Of course, that's anyway, even if we had some quietness in corporate activity, because the banks also asked us, please integrate the important Cytec and Remedica acquisition first, and then start with corporate activity again. So now you have it. You have a great set of results and 2 exciting new acquisitions, one in South Africa, strategically important, and a Sunwave, an amazing business in Eastern Europe, opening us new doors, which we wanted to open in order to make our business a complete global company in the health and care space, healthy home, healthy you, healthy life. Thank you very much for your attention, and floor open for questions.
Sorry, do you mind?
What opportunities do you still see in South Africa and Africa, rather than just say moving abroad completely?
So of course you have seen now the acquisition of the Cipla business, which is based 90% in South Africa. So this will add 33% on an annualized number to the Phytovet division. In Africa, we have at the moment an organic growth strategy where we work with agents and distributors. We are still looking, not first priority, but we're still looking for the right acquisition in Africa, but we haven't found this yet. But when you take Remedica's business is probably 90% outside of Central Europe. A lot of that business goes into Northern Africa, Eastern Africa, so from Remedica, because when you look at our geographic split, like I said, the geographic split talks about the jurisdiction of the company. So Remedica is shown as a European business, but their sales go into emerging markets. So Africa is important in our growth strategies from an organic point of view. Acquisitive, we have to see. Your question regarding South Africa, we have still a pipeline. The coast-to-coast deal team who works for us exclusively still finds us bolt-on acquisitions, but this is the difference. In Europe, we look more for platform companies. In South Africa will be bolt-ons. So Cipla is a bolt-on, even a sizable bolt-on with 31 million PAT in March 2016, quite a sizable bolt-on, but it's a bolt-on to our Phytovet division. So South Africa bolt-ons, internationally will be more platform companies. Maybe from my side, in the annex of the booklet, you will find, like I said, market data to our market leading positions. Also at the end, we have attached a share register. And like you can see on the share register, our BE shareholding has nicely increased, our international shareholding has nicely increased, and our female shareholding also. So also we tick the boxes there, what is important in the South African context. And to the international visitors on the webcast, international shareholding now 17%. We're showing the numbers there for end of December. So in the last weeks, there were more international shareholders coming on board. So 17%, I think this is not there where we want to have it, but it's a good start because 1 year ago it was 5%. So there's a lot of interest actually internationally also to the Ascendis success story. Yeah, then there are no questions, no comments, then I thank you very much for another set of good results I could present to you, but also thank you for your support. Here are some shareholders, some analysts, some shareholders who have supported us over the years, and I'm pretty sure that also after these good results, our share price will follow in the midterm exactly that development, growth, successful growth and profitable growth. Thanks very much.